We're looking at an analysis report, a very high-energy one titled, BMNR crashed 11%, time to buy the dip. Analyst targets $76.
Right.
The core argument is that BMNR's recent drop to around $30 is a major buying opportunity, pointing to a PE of just 2.3 and that big $76 analyst target.
And the foundation is definitely there. You can feel the conviction. The numbers they pull out, 13 billion market cap, that low PE, it's compelling.
It is. So our goal here is to really take that strong case and make it, ironclad.
Exactly. To build on its strengths by focusing on completeness and just making it more robust.
Okay, so let's jump right in with that 11% drop, since that's, the headline.
Yeah.
And look, that's not wrong. BMNR absolutely is a high-octane proxy for Ethereum. Volatility is baked in.
Right.
But I think the analysis report could significantly strengthen its thesis by providing a more thorough, structured assessment of the risks that come with that high beta status.
So you're saying just calling it sentiment isn't enough?
It's a weakness, yeah, because for an aggressive play like this, volatility is part of the deal. But sentiment is just another word for fear, right? And that fear translates into real, quantifiable financial risk. By just dismissing the drop as, transient noise, the report kind of minimizes the structural risk of being a high beta asset.
What if it's not just a Tuesday afternoon slump?
Exactly. What if it's driven by something more systemic, a regulatory shift or a real technical problem with Ethereum? The current framing just doesn't quantify the downside.
So the argument is vulnerable. It's strong, but it leaves this obvious door open for a counterargument.
That's it. The weakness isn't that the assessment is wrong, it's that it's just, it's incomplete. It describes the risk without actually modeling what happens.
Right. Okay, so what's the suggestion then? How do you fix that?
You have to define the scenarios where that $76 bull case actually gets invalidated.
Oh, I see.
You need to establish specific, quantifiable support levels that are actually tied to the company's fundamentals.
So you're turning risk management into part of the actual investment thesis.
Yes. It makes the whole thing much more robust because you're telling the reader, we've thought about the downside.
But doesn't that dilute the punchy, high-conviction tone they've established? If you spend too much time on risk mapping?
I don't think so. Not if it's done right. It actually adds authority. Anyone can yell, buy the dip.
Right.
But a truly authoritative report says, buy the dip, and here's why. Even if it drops to $25, the underlying assets still give us this margin of safety, and our thesis is only broken if we breach this specific level.
It shows you've done the homework.
It shows competence. So, for a concrete example, you should structure a dedicated risk mapping section.
Okay.
And in it, you detail specific risks, not vague stuff. Tangible things. Shifts in Ethereum's technical roadmap, new regulations on mining, interest rate hikes impacting their capital spending.
And you have to tie that to price action.
You have to. Give concrete examples of critical price points. You could literally write something like, if the stock breaches the $25 level, our fundamental thesis is negated because, and then you explain why. Maybe that's the point where their debt covenants get triggered or something.
That shows you've defined an exit, which is, critical for a high-risk asset like this.
It elevates the whole piece. It moves it from a simple call to a strategic plan.
Okay, that's a fantastic point. Shifting from dismissing volatility to quantifying it. Let's pivot now to the valuation itself. That's what's driving the call.
The PE of 2.3.
That and the claim that you're essentially buying Ethereum exposure at a discount to book value.
Which is a fascinating hook. It moves the discussion from, market noise to actual intrinsic worth.
But
the impressive PE ratio, while it's highlighted as key evidence, needs to be better integrated with that discount to book value claim.
I see. So they're presented as two separate facts. The report says, here's this massive treasury of digital assets, and also separately, here's the super low PE.
Exactly.
What's the mathematical connection between them?
And why is that a problem?
The problem is that for a crypto miner, a PE ratio is, it's notoriously unstable. It's cyclical.
Because earnings fluctuate wildly with the price of crypto. Right, and network difficulty, energy costs, everything. If Ethereum drops 20% next quarter, that PE of 2.3 could easily jump to 5 or 10, not because the company is less healthy long-term, but just because of cyclical earnings pressure.
So relying only on the PE doesn't really support that discount to book argument. It makes the valuation feel a little speculative.
Incomplete is the word I'd use. You need to anchor the thesis in something more stable than last quarter's earnings.
Something tangible.
The intrinsic asset value. So the suggestion is to anchor the valuation specifically on the balance sheet, on the actual value of their Ethereum treasury.
So you're making the discount claim tangible.
You're separating it from the volatile PE multiple. It changes the entire pitch.
How so?
It stops being a speculative call on future earnings and becomes a deep value play based on liquidation value. You're not buying what they might earn, you're buying what they have right now.
Okay, so give me the actionable example. How do you put that on the page?
You structure the argument to explicitly calculate the value of the digital asset treasury per share. You have to do the math for the reader.
So they can see the margin of safety for themselves.
Precisely. You show them how the current $30 price is covered by that underlying asset value.
Can you give me a specific phrasing?
Sure, you could calculate that, say, $15 of the $30 share price is backed purely by their liquid Ethereum holdings.
I see.
That completely reinforces the exposure at a discount idea way more powerfully than just pointing to a low PE. It provides a clear, asset-backed floor. It makes the discount to book value claim undeniable because the math is right there.
That completely changes the game. It takes a strong argument and makes it intellectually robust. Okay, let's move to the third point, the rocket case.
The punchline?
Yeah, the 145% upside, from around $30 now to that analyst target of $76.
It's very compelling. But the way it uses that $76 target, it risks making the report reliant on an external authority.
A borrowed conclusion.
That's a great way to put it. It feels like a borrowed conclusion. The weakness isn't that the target is wrong, but that the report just states it without showing the work.
It's basically saying, trust this analyst.
Anonymous analyst instead of the data you've just spent the whole report laying out. It's a huge missed opportunity to reinforce your own work.
It doesn't answer the why. Why would an analyst get to $76?
Exactly. What are the assumptions baked into that number? Are they assuming the PE expands to 5x or 10x? Does it need a crypto bull run to continue into 2026? Without that context, $76 is just a headline. It's not a conclusion that flows from the report's own logic.
I see the opportunity here. You need to bring the logic in-house, shift the trust from some external firm to the math inside the report itself.
That's the move. So the suggestion is to dedicate a section to actually reverse engineer that $76 target.
Okay.
You postulate the inputs required to get there. For example, what PE multiple or what net income growth would justify that valuation?
That completely flips the narrative. It goes from analysts say 76 to the fundamentals in this report support 76, and here's how.
It makes the headline an internally verifiable fact. This is how you build originality and trust. You reframe the argument as a kind of sensitivity analysis.
Showing how little has to go right to get to that price.
Yes. Give me a specific quantitative model for how that would look.
Let's hear it.
You could frame it something like this. To justify the $76 target, which implies a market cap of roughly $32 billion, BMNR would only need to trade at a PE multiple of 7.5 times its 2024 earnings.
I see.
This is still dramatically undervalued compared to the average tech PE of 20. In other words, $76 isn't an aggressive target. It's a conservative one, based on minimal multiple expansion.
That's powerful. You're using the report's own data points to cement the logic of the target.
And it makes a case so much stronger.
Okay, that was a really comprehensive look. The underlying conviction in the report is clearly strong, but these structural points could really elevate it.
I agree. The foundation is rock solid. The data points, like that PE, are genuinely powerful. These suggestions are all about closing the gaps and making sure the final conclusion can withstand any scrutiny.
So, to quickly recap the actionable suggestions here. First, strengthen the analysis by actually structuring and quantifying the downside risks. Don't just dismiss volatility.
Right. Establish those critical support levels. Make risk management a feature.
Second, deepen that valuation argument. Go beyond the PE and mathematically link the Ethereum treasury to that discount to book value claim.
Show the per-share liquidation value. Give the reader that margin of safety.
And finally, integrate the logic behind the $76 analyst target. Reverse engineer it.
Make that upside potential a direct conclusion of your own work, not just a borrowed headline. Establish your own persuasive authority.
Absolutely.